Good morning, everybody. It is June 22nd, and you are watching MarketStream.live. Welcome. This is where we take a look at everything that's happened in the overnight action in Asia. My name is Joseph Cusick with the Cusick Group Securities offered by MoneyBlock. Let's jump in. Now, what we want to do is set the tone really today, which is we had a market that's uninspired. So far, the overnight session, we saw mixed action across the Asian region. And when you look at it holistically and from an emerging markets perspective, you take a look at EEM. Now, this is an ETF that tracks the emerging markets. So you have China, and then you have some other ones, smaller ones, India, just markets that you normally would think, okay, I'd like to be invested in. I think, I hear about some Chinese stocks. I hear that they just got included in an all-world index. How do I actually participate in that? EEM is a great product to take a look at. It is optionable. And for those of you that watch the show, you'll understand why that's important over the course of time, where we can do strategic approaches that are going to minimize risk, minimize risk capital, as well as define our potential opportunities as well as our risks. EEM right now is trading below its 20-day moving average, but above its 50-day moving average. What does that tell you? There's a battle going on in the emerging markets. The bulls are still in control, but on the short-term basis, they're weak. They've been knocked on their heels, not on their butts yet. I want to see a challenge right here of this $40.77 on EEM if, in fact, emerging markets are going to be under some pressure. Implied volatility, which is my barometer of expectation of big violent moves in these underlying assets, EEM has an implied volatility rank of 6.2. To give you context, folks, that on a scale of 0 to 100 is very low. So despite the fact that we have huge geopolitical headlines, we have economic headlines like lack of inflation being the most notable one that we'll talk about today. The bottom line is that there's low expectation of big violent moves until we start getting tested. Now, where do you understand where you're getting tested? If you start breaking these levels. In this case, after grinding to the upside, a break of the 20-day, there's uncertainty. Market's down. It was up yesterday. We see that if it breaks through this level, the next level of support is about $3 below that. So you want to watch this stuff very closely just so that you can give context and manage your emotions. Now, taking a look at Japan, the overnight session, let's just say that it was muted at best, down about 0.14%. That's good for 28 points on the $20,000 index. What was the notable headline was Takata. You remember the airbag company that has been, basically sued and now is going to be basically filing for bankruptcy, it looks like. That's what Reuters was putting out headlines on. That put a little pressure. Also, watch the currency. As we talked about, the Japanese yen strength has pressured the market. Right now, if you take a look at Japan, keep an eye on FXI. Now, EWJ. EWJ is an ETF that tracks Japanese stocks. And you see this balloon line here has basically been trailing or tracking the Nikkei index that we look at every morning. EWJ is an ETF that trades during our market hours, and they're here in the States. And the reason why I use this as a proxy for Japan is because it is optionable and it's relatively liquid. Now you can clearly see that while the Nikkei has been dropping, so has EWJ. Right now, EWJ has a very low implied volatility rank. What is that telling me? Not a huge sense that there's going to be big violent moves, just these grindy moves. The trend, how do I know what the trend is? I use these moving averages. If the stocks are trading above these moving averages, it's bullish. If it's below, it's bearish. This gives me context. It doesn't mean that it has to stay that way or that I have to be bullish or I have to be bearish. It gives me context. Then I look at implied volatility and say, well, what's the expectation? Is there an expectation that this thing could start moving violently in either one direction or the other? Right now, implied volatility rank is at 6, so no. We're seeing basically about a 27-cent move being priced in the FXI contract, which is trading at $39 for the remainder of this week, so today and tomorrow. So you have less than a 1% being priced in. And then going into the end of next week, let's say around 50 cents, 49 cents. So again, a little over 1% being priced in as potential range for this underlying, and that makes sense. Look at how tight the Nikkei has been trading, and you will see that this will follow suit. So we'll watch this one very closely, but now you have context on EWJ. Taking a look at China. Now China, there's a lot of activity. The Shanghai Composite did finish down 8 points. That's a 0.25%, almost 0.3% to the downside. You can clearly see though that the Shanghai Composite has been moving to the upside quite nicely recently. But you will also see that FXI, this is the large cap ETF that tracks the 30 largest capitalized stocks in China. This has also been moving in lockstep to the upside. You see the blue line, right? And then you just see this grinding action. Now it pulled back. So you see when it pulled back, this was right before the announcement that about 220 large cap stocks are going to be added to the MSCI index, which is this all world index. Now, those Chinese Class A stocks, that was a little bit of a firmness. We saw yesterday, it got it over the 200-day moving average, but it couldn't really hold that close. You saw that it closed down. Let's see how FXI opens up today. Now, taking a look at FXI, you see the implied volatility rank is at 11.4, low. What is that telling you about Chinese stocks? Don't expect huge violent moves. Now, recently we've seen some big ones than we've seen over the last couple of weeks, right? These big, long candles that you see here, which explains why it's at 11.4% versus 6 or 4 on the rank. Right? The 11.4 is a little bit higher than its peers that we're seeing in like Japan. Take a look at Hong Kong, which is off the mainland, and you can see that Hong Kong has been grinding to the upside. The Hang Seng has been under some pressure as of late, and as a matter of fact, settled right below its 200-day moving average. That is something where you know that now the bulls in Hong Kong are under some pressure. Makes sense because there could be a cycle out from Hong Kong back into the mainland, especially if you see some growth opportunities there, because this is the thing that the investing and trading community is going to look for. Where is growth? Right now in the United States, we're not seeing it. Yes, we're seeing all-time highs, but boy, when you're at all-time highs, that doesn't seem like the most ideal situation to say, oh, we should be buying stocks here in the States. That's why you've seen a cyclical move earlier this year and late last year into Europe. Now Europe, as it starts to pick up, you're starting to see that there's some nibbling potentially in areas like China that has a GDP forecast of 6.2% and right now PE ratio for the market coming in at 8.2%. So it's very interesting. We'll watch this very closely. EWH is the ETF that tracks this index. As a matter of fact, if I actually bring it up, I'm going to take that one down. Excuse me. You will see that EWH right now, pretty much so tracking the market, dropped a little precipitously here. Again, the way that these ETFs, they may trade a little bit more volatilely than the underlying, but now saying that, I look at the volatility rank. When I look at this picture, it looks like it dropped off like a stone in water. But as a matter of fact, looking at the implied volatility rank and then actually looking at the price movement in EWH, you could see that really what happened was it's now in this battle zone. So the Hong Kong ETF has dropped precipitously through the 20-day, now challenging the 50-day. But when I say precipitously, it only dropped about 70 cents, 60 cents. So while that is significant in a $20 stock, it's still not at a point where all of a sudden you're saying the bulls and the trend has shifted. It hasn't. The bulls are still in control. This could just be the movement out of Hong Kong back into China and into the mainland after what was some uncertain times about basically the government, how they were going to approach the banking sector, specifically the lending sector in the property markets, as well as how they were going to handle some of the leverage risk that they're seeing in the financial markets. Now that they see that there is a growing economy, there is a little bit of a sigh of relief for at this juncture in China, but we'll have to continue to watch the inflation numbers to see if that pans out. Finally, taking a look at the Sensex. Now, this is India. Now, India has been moving to the upside very nicely. What's notable here, though, is if you look at the ETF that tracks India, EPI, doing just about the same thing. Grinding. We did have a little blip here, but EPI has been moving to the upside. And as a matter of fact, if I remove the EPI, you could see that it's challenging its 20-day moving average, but much like the Indian Sensex index, it's still in a bullish trend. It's been grinding here, and this is an area where if I were looking at this and I was invested in India or EPI, really the only thing that you could do is hope that you have a lot of dividend-paying stocks to offset this lack of movement, or you're doing something like buying an EPI underlying ETF. I'm not recommending that. That's just an example. And then selling out of the money calls. Let's say, for example, the 30 Delta call. Just for example, let's say that's at the $26 or $27 level, where you're bringing in income that's reducing your cost basis of your original purchase price. So right now, it is straddling that 20-day moving average. So the short-term bulls are on their heels, but we're watching that market very closely. All right, folks, that's it for the overnight action report. Gave you a lot to chew on, a lot of opportunity that you can look in Asia. And now you have context, not only on the market movements, but now you can understand the vehicles that you can start looking at, monitoring, so that when you go talk to your advisor, or when you're looking at your investments, you're going to say, do I have enough exposure to this region? Because this could be the area where we're going to have the next step in growth, and that's where I need to be. All right, we'll be back at 7:45 Central. Central, and 8:45 Eastern, where we're going to be talking about everything in Europe. See you then.